You've seen them, right? Those flashy ads everywhere. Get funded, trade our capital, keep 80% of the profits. It sounds like the dream. Pass a challenge, get your hands on a six-figure account, and finally start making some serious money trading. The confetti practically flies out of your screen. You get the certificate, you're a funded trader. But then, what happens? Often silence. Weeks, maybe months down the line, that account is just gone. Poof, vanished. So, what went wrong? Well, the statistics paint a pretty grim picture. Some sources suggest that while maybe 5 to 10% of traders manage to pass a prop firm challenge, only about 20% of those actually see a payout. That means a tiny, tiny fraction, possibly as low as 1 to 2% of everyone who tries, ends up making consistent money. The hard truth is, getting funded is just the first hurdle. Keeping that account, growing it, and actually getting those payouts, that's a whole different battle. And frankly, it's a battle most traders are completely unprepared for. Forget the challenge for a second. That was just to get your foot in the door. The real test, that starts the moment you get that funded account. And the brutal truth is this: most traders don't fail because their strategy was bad for passing the challenge. They fail because they were never really ready for what comes after. They crash and burn because of a nasty mix of emotional meltdowns and catastrophic strategy mistakes they just didn't see coming. Today, we're not just going to scratch the surface. We're going right into the heart of why so many funded dreams die. We're uncovering the brutal truth of why most funded traders fail. Let's start by shattering the illusion of what being a funded trader really means. Look, the idea of a funded account is incredibly appealing. It promises freedom from being stuck with a small personal trading pot, giving you the chance to trade serious size without risking your own savings. For a lot of folks, passing that challenge feels like the ultimate win, the peak after months or even years of grinding. There's a real dopamine hit, a feeling of, I've made it. You've proved you can trade by a set of rules and hit a profit target. But here's the first dose of reality. The challenge environment, as tough as it is, often isn't a perfect mirror of what it takes to trade sustainably long-term with that funded account. The pressure changes, your whole mindset shifts. Suddenly, it's not about nailing a one-off target. It's about consistent performance, week in, week out, with the prop firm watching closely and usually having even stricter rules. The stats are pretty sobering. Many reports show really high failure rates once traders actually get funded. Some data even suggests that 70 to 80% of traders might blow through their capital within the first 3 to 6 months on a funded account. Why? Because getting the keys to the kingdom doesn't automatically mean you know how to rule it. Moving from challenge passer to consistently profitable funded trader is like crossing a giant canyon, and a lot of people fall right in. And it all kicks off with the war inside your own head. Now let's dive into the emotional gauntlet, because psychology, it's the first thing that wrecks most funded traders. They say trading is 80% psychology, maybe even more. With a funded account, that gets cranked up to 11. That feeling of it's not my money, which might seem like a safety net, can actually be a double-edged sword. Sure, it might lessen the fear of losing your own cash at first, but the pressure to perform and protect the firm's capital, that unleashes a whole new set of psychological demons. First up, let's talk about emotional trading. This isn't a new concept, but it can become a real monster with funded accounts. 1. Fear of losing the account. You work so hard to get funded, right? The thought of losing it can be paralyzing. This can make you hesitate, miss perfectly good setups, or cut your winning trade short. Trying too hard to protect the account can, ironically, lead to its downfall because you're trading scared, not smart. 2. Greed and overconfidence. You passed. You're the trading genius. Time to make a fortune, eh? This kind of overconfidence often leads to taking way too much risk, ignoring the rules, or feeling like you can't lose after a few good trades. You start daydreaming about that massive payout, the lifestyle, and suddenly your carefully thought out plan is out the window. 3. Revenge trading. A few losses hit you hard. That drawdown limit is starting to look scary. Frustration is building. So instead of taking a break, you jump right back in, trying to win it all back in a flash. This is a classic way to kill an account, driven purely by emotion, not logic. You're not trading your plan anymore. You're fighting the market and your own bruised ego. 4. FOMO, fear of missing out on payouts. You see other traders posting their payout screenshots. You feel the pressure to get yours and fast. This can push you into forcing trades that aren't really there, chasing so-so setups, and just generally overtrading, all in a desperate attempt to hit that payout number. Next is a big one, a lack of discipline. You were disciplined enough for the challenge, but can you keep it up? Prop firm rules are often much stricter and more detailed than what you might be used to on a personal account, or even during the sometimes more forgiving phases of the challenge. Daily drawdown limits, maximum loss limits, rules about consistency. These aren't just suggestions. Yet, when those emotions we just talked about kick in, traders start to bend them. Just one more trade to get back above the daily loss limit. I'll just up my position size a bit to hit the profit target faster. This lack of discipline is a one-way ticket to losing your account. Pros stick to their plan, even when it's boring or feels uncomfortable. Then there are those unrealistic expectations. So many traders get funded and think they'll be banking thousands or tens of thousands in their very first month. They see that big account balance and assume their profits will just scale up instantly. But sustainable trading? That's usually a game of inches, not miles. The pressure to make huge, quick profits leads to over-leveraging and super high-risk moves, which is the exact opposite of the consistency prop firms actually want to see. Successful funded traders are often aiming for modest, steady monthly returns. And this is crucial. Insufficient real trading experience. Demo accounts, and even challenge accounts, don't fully prepare you for the psychological weight of managing a large live account, even if the capital isn't technically yours. The emotional feedback is just different. That feeling of responsibility, knowing you're being watched, the real impact of profits and losses, it all hits differently. This gap between practicing and the real deal pressure cooker is where many traders stumble. The battle is so often inside the trader's own mind. Losing the account isn't just a financial setback. It's a huge hit to your confidence and how you see yourself as a trader. But it's not just emotions. Strategy plays a huge role too. Let's break down the technical landmines traders step on. It's not all in your head though. Beyond the emotional ups and downs, a whole bunch of technical and strategic mistakes pave the road to a blown funded account. And often these are tangled up with those psychological errors, creating a nasty downward spiral. Poor risk management is probably the #1 account killer. You think passing a challenge means you get risk, but actually applying it consistently when the pressure is different, that's another story. Many traders just don't set proper stop-loss orders, or worse, they move them when a trade starts going against them. They might risk way too much on a single trade, trying to hit profit targets quicker, or they completely ignore the daily drawdown and maximum drawdown limits set by the firm. And those rules are usually non-negotiable. Break them, and it's often an instant goodbye. Proper risk management means keeping your risk per trade tight, usually 1 to 2% of the account, and treating all the firm's limits like sacred texts. Over-leveraging is a very close second. The idea of controlling a huge position with a relatively small amount of margin is super tempting. But leverage is that classic double-edged sword. It cranks up your gains and your losses. Many funded traders, especially those with sky-high profit hopes, use way too much leverage, which can lead to smashing through drawdown limits in no time. You need a balanced approach. Lack of a continued trading plan, or, more often, deviating from it. You had a plan to pass the challenge. Awesome. But what about after you're funded? Is that same plan robust enough for the long haul? Does it factor in the specific rules and the unique psychological pressures of being funded? Many traders either don't have a really detailed plan for their funded stage, or, more commonly, they ditch their plan the moment things get a bit tough or a bit too exciting. A solid plan should define your entry and exit points, your risk-reward ratios, how you size your positions, and how you'll adapt to different market vibes. And you absolutely must stick to it with ironclad discipline. Overtrading is another common mistake. This can happen because you're bored, you feel pressure to hit those profit targets, or you're desperately trying to claw back losses. Taking too many trades, especially if they're low-quality setups, just racks up commission costs, wears you out mentally, and makes it much more likely you'll make emotional blunders. Sometimes, setting daily or weekly trade limits can help you stay focused. Here's a critical error that's often overlooked: ignoring prop firm rules. Every prop firm has its own very specific set of rules. These can cover everything from how much you can lose in a day or overall drawdown to rules about consistent trading, what you're allowed to trade, restrictions around news events, limits on your position sizes, and even how long you have to hold trades. Trust me, ignorance isn't bliss here. It's a fast track to losing your account, no matter how profitable you might be otherwise. Many traders just skim these rules, only to find out they've broken one when it's already too late. Inadequate preparation and testing for the funded stage. Your challenge strategy got you in the door. That's great, but is it really optimized for the long game, for the specific conditions of the funded account? If you don't adapt, or if you stop testing and tweaking your approach once you're in the live funded environment, you're setting yourself up to fail. What worked to pass a challenge with perhaps slightly looser drawdown rules might completely fall apart when those drawdowns are tighter and enforced to the letter. And finally, not adapting to market conditions. Markets are always changing. A strategy that was printing money last month might completely stall out this month. Funded traders who fail often cling rigidly to one approach, unable or unwilling to switch things up when the market is clearly telling them something new. Being flexible and always learning is absolutely key. So, what happens when it all falls apart? Let's talk about the brutal impact and why it hits way deeper than just your wallet. So, what's the real brutal truth of all this failure? It's not just about losing access to the firm's money. The financial hit is obvious. You miss out on potential profits, and those challenge fees are gone. But the psychological damage is often way more devastating. There's that crushing blow to your confidence. Self-doubt starts creeping in, making every future trading decision feel 10 times harder. Many traders go through serious frustration, anxiety, and even a sense of shame or total failure. This can lead to what some call trading paralysis, where you're just too scared to take any trades at all. Or worse, it fuels a cycle of jumping back in too quickly without learning anything, which just leads to failing over and over again. For anyone hoping to build a real career in trading, blowing a funded account can feel like a massive setback. It can damage your own self-belief and make it incredibly hard to trust yourself in the markets moving forward. The dream that felt so close suddenly seems miles away. You're not just back at square one. Often, you're in an even deeper hole of self-doubt than when you started. But it's not all doom and gloom. Here's the part that matters most: the seeds of change and the real path forward. Okay, I know this has all sounded pretty heavy, but the point isn't to scare you off. It's to arm you with the truth. Because recognizing these patterns, understanding these traps, is the absolute first step to actually avoiding them. The way forward isn't about finding some magical holy grail indicator or a secret strategy. It's about mastering yourself, your emotions, and how you approach risk. It's about building unshakable discipline, treating your trading like a serious business, and truly respecting the rules of the game. It's about planning meticulously, not just for the challenge, but for the long journey ahead as a funded trader. It's about constantly learning, adapting, and being brutally honest with yourself. Keep a trading journal. Track your emotions alongside your trades, and make sure you learn from every single mistake. So, have you been through this? Have you wrestled with these demons with a funded account? Or are you maybe getting ready to take on a challenge right now? I'd love to hear about your experiences, your struggles, and any insights you've gained in the comments below. What's the biggest lesson you've learned? Or what's your biggest fear about this whole journey? And hey, if this dose of brutal truth resonated with you, if you found it valuable, do me a favor and hit that like button. Subscribe for more honest insights into the world of trading, and ring that notification bell so you don't miss our next video. Your engagement really helps out the channel and means we can make more content just like this. Getting funded is definitely an achievement, no doubt about it. But it's not the finish line. It's really just the start of a new, much tougher marathon. The vast majority of funded traders don't fail because they're inherently bad traders. They fail because they seriously underestimate the huge psychological shift and the strict discipline needed to actually maintain and grow that account. The brutal truth is that the prop firm model, while it offers a fantastic opportunity, is also designed to weed out those who can't consistently manage risk and their emotions when the pressure is on. Success here isn't about getting rich quick. It's about survival, consistency, and slow, steady growth. Understand the pitfalls, prepare yourself for the mental battle, and commit to discipline above everything else. Only then can you really hope to be one of the few who not only get funded, but stay funded, and ultimately thrive. Trade smart, stay disciplined, and face the truth.